why do we still focus so much on companies beating estimates?
I believe the smart money knows it's about the delta. I think it's just ingrained in us to go, you watch Sports Center in the morning. Who won the game last night? You want to know who won the game last night. You want to see what happened. But when it comes to stocks, it's not about who won the game last night, because the definition of a stock price is the present value of future cash flows. So every day the market's open, it's not trading off of what's happening at earnings or what happened 3 months ago on earnings. It's predicting what's going to happen to earnings a year from now, and then the change of those expectations over time that new pieces of information come out. But I think it's inherent in all of us to know what's the scorecard. And there is good data in there. You need to know who won the game last night to be able to tell how they're doing, to see if they can do well in the future and the guidance. But it is all about the delta, and that a lot of parts where we don't want to focus on just the beat alone. Those numbers tend to get manipulated. They tend to get lowballed by the company. So you always have about 80% beating the estimates. When that happens every quarter, it's not that much of a surprise anymore.
Hey there, everyone. Dave Keller here with Market Misbehavior, and welcome to our latest episode of the Market Misbehavior podcast. Today, we're chatting with Nick Raich. Nick is the founder of The Earnings Scout. I met Nick when we lived in the Cleveland area a number of years ago. He's had a successful career helping institutional investors analyze earnings through a brokerage, and then broke off on his own and launched The Earnings Scout. What you're going to find in this conversation with Nick is all about the most important evidence to follow when it comes to earnings, looking at earnings estimate revisions. We're going to talk about what earnings are indicating here as we kick off Q1 earnings season. Some of the initial takeaways, as about 10% of the S&P have already reported here in mid-April, and why the strength in earnings could be the reason why this market is not nearly optimistic enough. So please enjoy this great conversation with Nick Raich of The Earnings Scout. Super excited to be catching up again with Nick Raich, founder of The Earnings Scout, coming to you from Northeast Ohio. Nick, good to see you again. How's life, okay?
Oh, it's doing great. Great to see you, Dave.
A lot of things I want to ask you about. And you had a recent note, Nick, and the title was "The Setup is a Rocket Ship, Not an Alligator Jaw." Now, you were on the show. It's been too long. I mean, it was at a point in 2025 when you came on the show and talked a little bit about the alligator jaw. But what does that title mean? And if you could just kind of summarize what that alligator jaw would represent, I think that'd be a great place to start.
Well, at the beginning of 2025, there wasn't what we say an alligator jaw open in the market, which is a warning sign. And the way we define an alligator jaw is we're measuring the earnings estimate changes for in this case, the S&P 500. We do it for 4,000 companies. But with regards to the S&P 500, we take all the estimates and then we look at them, how they're moving across 7 days, 30 days, 90 days, and whether they're going up or down. But we're taking a look at the percent, the rate of change to those estimates. So we always at the Earnings Scout say it's not about if estimates are going up or down. That doesn't matter for stock prices. It matters if the estimates are getting better or worse. And the only way you see that is rate of change. So an alligator jaw we define as a divergence that occurs when you have 2 quarters in a row or more, and this would be 6 months or more of weakening on a rate of change basis, S&P 500 estimates in the aggregate as the price keeps going up and up and up. So it's a divergence. It's a 2-quarter divergence. And when that happens, it's always been a warning sign for stocks. And over the last 35 years, it's happened 7 times. It's predicted every major bear market and every major correction. So at the 2025, we had that alligator jaw open. We went bearish until May, until we started to see the jaw close with the price drop last year, the 19% drop in the price, and estimate trends start to improve again. This year, that's not happening. And Dave, it's actually interesting. We've had that alligator jaw open 7 times over the last 35 years. I've never seen the reverse of that. I've never seen stock prices go down for 6 months or more and the earnings estimates improve. So the market tends to always go higher, and we're at all-time highs, so it does that. So anyone who's been a long-term perma bear is wrong, and every perma bull's been right. But we're looking at the actual estimate data to see that. There's never been the reverse of that occur, but what we did see beginning at the end of January this year is the price drop. We had a 9% correction in the market. And during that entire time, the estimates were improving. So we had a 2-month divergence. So it's not enough to say it's a rocket ship. But if I define the negative divergence, weakening earnings, rising price with an alligator jaw for 6 months or more, if I ever get the 2 quarters in a row of improving earnings and falling price, good flag, that was a rocket ship. And I flagged it with a rocket ship because we're at 2 months and said, hey, if we get some fear subsiding on Iran, the earnings estimates are improving here. We don't see this. Positive divergences don't last long in the market. So you need to be prepared for it. And that's what we were for. And it certainly has rocket ship since March 30th.
It's felt that way with the S&P closing above 7,000 for the first time here this week, which is a pretty impressive milestone to eclipse. And to your point, I follow your work closely. I enjoy sort of reading your comments on what's going on. And as you mentioned, you've been tracking during that pullback sort of around the conflict in the Middle East, earnings remaining quite strong. And I think that was one of the data points that I was seeing from you that really, really resonated. When we've thought about the impact on events in the Middle East, there's sort of that headline impact, that headline reaction that we saw with, a big sell-off as hostilities began, big recovery as a ceasefire was announced. We've had a lot of volatility in equities. Earnings have remained fairly strong. What do you make of the argument that the impact of what's happening in the Middle East now is not something that's going to be felt in earnings until down the road? Is there a lag that we're just waiting for potentially?
That's a great question. So we look at the spike in oil prices. That was the main driver of the sell-off, right? Everyone was worried about that and saying it's eventually going to hit earnings. And people say it's not about earnings, it's about oil. I always say it's always about earnings. Oil is a variable that impacts the future earnings, and the market trade off of that. It was interesting to me because we knew the spike was coming in the oil prices. And the companies that were reporting February quarter ends during the month of March when we had that big spike in oil prices, they were guiding the analysts higher after reporting. And you would think, why are they doing that? Are you crazy for doing that? So what's going on behind that? And either it's A, they didn't think that the spike in oil was going to last long, so they didn't forecast it out to the analysts, and the analysts didn't change it. So maybe people do believe it's transitory, and then the prices are going to recede, and it's not going to impact earnings 6, 9, 12 months from now, that it's going to recede back. Maybe that's it. Maybe that's a risk, right? Because if oil prices did go to 200 a barrel and gas went to $5 or $6 national average on gas prices, that would certainly impact earnings and hit them. But I just don't think people believed that it was going to happen and be sustained. And the companies that were giving the guidance were seeing other parts of their business that were offsetting that enough that they could actually raise estimates. And that's very atypical to raise estimates after reporting, because typically after companies report, they tend to temper their expectations to Wall Street to get them to cut estimates to lower the bar. So the fact that they were raising them in light of this had me scratch my head going, wow, this is just amazing.
Oh, no, some really good points in there, Nick. I guess another way to think about this, there's generally this sense as the S&P is pushing above 7,000, there's definitely a sense last year into the end of last year, beginning of January, that the market felt very overextended. It felt like we were leaning way over our skis and that some sort of pullback, we were overdue for a pullback because of that strength. How does that strength in the market compare to what you're seeing in terms of earnings expectations? Is the trend that we're now seeing maybe resuming to the upside, would you characterize it as justified by the earnings data that you're reviewing here today?
Well, if I look at last year, just before as Trump was escalating tariffs, and then this year, the difference was last year at this time, the market was overextended. We had the Alligator Jaw, we had weakening earnings, and then Trump escalated the tariffs and was on the verge of creating a global economic trade war, which would not have been good for anyone. Global trade war is like global thermonuclear war. It's a game where nobody wins. So Trump needed to do the pause for the market to then adjust to the worst case scenario. And then when he paused, it allowed the estimates to start improving. And if you think about it, last year at this time in April 2025, just before Trump paused the tariffs, most companies did not know what tariffs were going to be like. So they were making an extra 5 to 10% hit to their earnings for the uncertainty, to lower the ball part of the analysts. The moment on April 9th, when Trump came out of 2025 and paused tariffs, that extra 5 to 10% hit that the companies were guiding the analysts with went away. So it was an automatic improvement in the earnings. And we've had that improving earnings trends persist the entire time since that time. So that momentum is very positive. So that's the difference. This year we got positive earnings momentum. Last year we had negative until that pause came. So that's the difference. And the thing I think that's really interesting here is Trump is, I always say he's predictably unpredictable. He escalates the situation. This is his art of the deal negotiating tactics. I believe last year he threw out the worst case scenario with Liberation Day, with tariffs on hundreds of countries all at once, 200%. He throws out the worst case scenario. I don't think for a second that he means that, but yet that's his starting point to negotiate and go back to then ease it back to get a deal that he wants. I believe this year's Liberation Day, to me, his worst case scenario is when he came out and tweeted that he was going to end the civilization. Because, Dave, I can't honestly think of a worse outcome than that. I don't think Trump actually meant he was going to end the civilization, but he throws that out there to scare the Iranians, and then he's going to negotiate from there and then try to get a better arrangement and deal and posture for the U.S. So that may have been the moment that I think the market then digested and said, well, here's the worst case scenario here. It can only get better from here.
You know, when you're thinking about conditions right now with earnings, which appear relatively strong to your point, how do you reconcile that? I think, one of the concerning sort of broader economic indicators has been weaker consumer sentiment, signs that consumer sentiment is at relatively low levels. How do we reconcile estimates that appear pretty constructive and a consumer, data that appears less than ideal? How do we marry those two, or how do we reconcile that?
So a lot of the economic data points, we always say, can be noisy and you can drown in that data. And some of those sentiment polls tend to be more based on your political position. They tend to be biased samples, if you will. Whereas we look at the earnings, tell the real story. It separates the signal from noise because consumers can say they feel not that confident, but if they keep going out and spending, it gets reflected in the earnings data. So that's why we always say we try to drown out that noise, if you will, and not drown in the overall data. And the delta to the earnings estimates tell us everything about what's going on as opposed to speculating. Now, if you know for sure if the consumer is going to scale back, which I've never been able to predict human buying patterns, and I never knew like the pet rock was going to take off or fidget spinners in 2016s with kids. I can never predict what fashion trends are going to go, but people pick up on that and go. And we always say it gets reflected in the earnings data. So that really helps us eliminate some of the noise from some of the economic data points. So I really think you can drown on a lot of those economic data points.
That's some really good points in there, Nick. And again, having followed your work now for a number of years, I think that's what's most refreshing of how you approach things. It's really focused on the trends in earnings. And this is not the first time. What happened more recently where the market does one thing and you come out and say, look, the earnings seem fine. And sure enough, the market's recovered quite well. So to your credit, I think that's served you quite well. And I appreciate you helping us focus on the signal versus the noise. Just kind of pivoting a bit and thinking about this current earnings season that now we're embarking on. We've started now, and I think in your most recent, I think it was like 9-10% or so of the S&P companies have reported so far. It's been a lot of banks, a lot of financials so far. Any kind of early takeaways from what we've seen that, exudes more optimism or less relative to expectations going into the season here?
Yeah, so we're just under 10% of the S&P that had given us actual results to see above trend growth, above normal beat rates on the estimates. And we always say the beat rate, whether they beat the first quarter numbers or not, doesn't really matter. It's all about the estimate changes that go on. And that's the most important thing that we're looking at. And the outlooks the companies are giving right now that have reported, it's only 10%. So we got 90% to go. But this tends to be a great sample of what's going to happen and be the trend for the rest that report. We're seeing companies guide better than they did 3 months ago, 6 months ago, 9 months ago. So it shows the positive revision momentum is intact. So the rocket ship should remain intact here until we start to see deterioration. And maybe those consumer sentiment, maybe it does hit. If oil prices stay elevated for an extended time, maybe we start to see it go. But we'll notice it in the delta to estimates and we'll start to measure that right away. But we're not seeing that right now at all.
It's so interesting. You made a comment just there, Nick, in passing, and I'd love to just spend a moment parsing that out a little bit. You'd mentioned it's not about the company beating estimates for the quarter. It's about the delta in estimates. And that's something I learned years ago from meeting you and learning about your work. I'm like, oh, and you have the evidence to back it up. So my question is, why do we still focus so much on companies beating estimates versus some of the data that certainly appears to be much more helpful at understanding the earnings potential going forward?
I believe the smart money knows it's about the delta. I think it's just ingrained in us to go, it's like getting this, you watch Sports Center in the morning. Who won the game last night? You want to know who won the game last night. You want to see what happened. But when it comes to stocks, it's not about who won the game last night because the definition of a stock price is the future value or the present value of future cash flows. So every day the market's open, it's not trading off of what's happening at earnings or what happened 3 months ago on earnings. It's predicting what's going to happen to earnings a year from now. And then the change of those expectations over time that new pieces of information come out. But I think it's inherent in all of us to know what's the scorecard, what's their beating. And there is good data to be in there. You need to know who won the game last night to be able to tell how they're doing, to see if they can do well in the future and the guidance. But it is all about the delta, and that a lot of parts where we don't want to focus on just the beat alone, those numbers tend to get manipulated. They tend to get lowballed by the company. So you always have about 80% beating the estimates. So when that happens every quarter, it's not that much of a surprise anymore.
Epic sports analogy right there, Nick. Well done. I'll take that one. We'll remember that for sure. So as we, progress past the financials and get into some of the other areas of the market, technology is about 35% of the weight in the S&P. It's obviously a pretty significant weight. We've seen signs of a resurgence of optimism in the AI trade. Most recently, now software companies starting to improve quite again. In technology and some of the AI related areas in particular, can you speak to, again, is it similar to what we've talked about with other areas where the estimate revisions remain constructive? Are there any warning signs that you're seeing in those that would make you skeptical of this resumption of the AI trade?
I think the fear for the software companies, that seems like a legit fear, right? So if Adobe is going to sell less licenses because AI is so great, you don't need 100 licenses at a company, they're only going to sell 10. That's going to be a hit to their earnings. I get why the market speculates that's going to happen. We're just not seeing it from the analysts changing them yet. So is the sell side too slow and the buy side quick? But there is a disconnect there going on right now. And that disconnect won't last long either. Someone's going to be right. So maybe the fear is going to prove to be excessive with software companies. And when it does, then you're going to want to buy those improving earnings at a cheaper price. And they're going to be some of the best values in the market. And then other parts of the AI, they're just still booming. NVIDIA, Broadcom, ASML, we've never saw that their estimates take any hit whatsoever. Their estimates are going up at increasing rates at, say, NVIDIA. And the only thing that happened was a 10, 20, 30% pullback. So we said, they're on sale. And if you thought they were too expensive last year and didn't want to get in, you got a discount. There's a price tag. There's a 20% off sale on video. Well, maybe not anymore, given the run up at its hand this month, but it was there. And a lot of people, I always find this interesting when it comes to the market. They'll see the market go down 20% and get scared and want to run out, versus the market goes up 20% and they feel safer to them. So I look at it like it's all relative to the earnings and relative to the price and what value are you getting for that price.
Outside of the technology kind of AI trade, other areas of the market have not looked anywhere near as strong as the markets themselves, right? And we've seen that in areas like consumer staples, where we've had some pretty challenging performance over the last 12 months versus the strength that we've seen elsewhere. Do you see any of those sorts of areas of the market where it feels like things are mispriced, where the earnings is justifying a better price performance than what we're actually observing these days?
Staples was coming out of the gate this year, starting to outperform again. But It's March 30th turn, it's been the Mag 7, right? Yeah. That's where it's going. We actually thought that was the most mispriced area of the economy, because you got to buy the areas in the economy that have the best earnings, the most rapid acceleration and earnings momentum at discounts. So the market's quickly readjusting back to that once the fear has subsided somewhat from the Iranian war. And keep in mind, the Iranian war, the conflict, that might drag on, but as long as the worst of what we thought about it is behind us and the delta can go up higher from here, that could be great. Because if oil prices go up and keep going up, but at the rate of change of what oil prices go up, it gets factored in, so that momentum slows. We always say it's not just about the earnings momentum rate of change, it's the delta on everything the market looks at, and even the price. I know you're great at technical analysis, then there's something to be said there about the price momentum changing and all that. And I think that's because a lot of this information on earnings, I hate to say it, sometimes the insiders leak that information out, and that's why the price sees it first to something. You got to look at technicals with the fundamentals, because when you marry the two, then you get that confirmed completely that, yes, this is a sustainable trend.
I promise I did not encourage you to make that comment, Nick, but I'm glad that you did. And I would wholeheartedly agree. That's, through most of my career, it's been working with investors that focus a lot on earnings and the narrative and earnings growth over multiple cycles. But when you combine strong price action and improving price momentum with improving earnings momentum, that's when you come up with some really, really powerful combinations. So thanks for articulating that so well.
I say when you got 1+1 starts to equal 3.
That's well said. So you mentioned you cover thousands of companies, which means you are obviously getting down into the mid cap and then the small cap space. I feel like we've been announcing the return of small caps many, many times over recent years, and it's just never materialized because of, sort of the large mega cap dominance. Are you seeing opportunities in the small cap space? Is there strength to be had there, or is it still just sort of in a backseat to the other areas?
It's against the playbook. So when we get an extended bull market, when it starts, small caps should be the ones leading out of the gate. They're the high beta plays, right? They should be the ones taking off. I think some things structurally have changed. And it's with private equity. I think a lot of the great small companies have just paused for so long before going public. They wait, they stay private longer. So some of the great companies that could give us that boost early aren't there. And then they wait to go public when they're already in the large cap space. So I think that has structurally changed from 20, 30 years ago. I think because companies hold off on, being private for a longer time now. The earnings trends are about the same right now. So we have roughly a equal rated view of large cap versus small. But at the same time, we think the short-term trend here, we've been saying overweight the Mag 7. But as they're outperforming here, they are skyrocketing off. We do factor that in to the move and going, okay, so that's helping readjust the price back to where the earnings trends were. So our scores are getting lower and lower now for the Mag 7 compared to the way they were back on March 30th.
Great points there, Nick, and thanks for that. One other question I wanted to ask you about, and I remember 10, 15 years ago, a water cooler discussion at a big firm. We were talking about quarterly earnings reports because outside the US, there's some places where it's like a semi-annual reporting cycle or something like that. And, debating the strengths or weaknesses of the quarterly earnings cycle and what it means. And I've heard rumors once again of that being discussed about maybe getting away from that quarterly earnings cycle. How do you think about that potential change? Are there positives to that sort of evolution? Are there benefits to the quarterly data that you think outweigh the, challenges, more with the short-termism with management? How do you think about that potential change?
I think for the companies that truly think long-term, and don't worry about the quarterly earnings, they can do a good job of guiding the analyst community to say, okay, here's what we're doing in the short term. These are the expectations. Here's what we're doing in the long term. And they can still report the quarterly numbers because some of the companies that might not be as open and honest, I think we need to see what they're doing. At the end of the day, when you buy a stock, you're an owner in the business. And so if you're an owner in any business you invest in, whether it's a private business, whether it's a public, how is she going to measure your success other than the money you're making off of it, right? Is the business making money? And so if you don't know that and people are disclosing that from you longer and longer and saying, no, just trust me, I got it. That would be the longer reporting cycle. Now, at the same time, I don't want companies that feel the pressure to manage to every quarter of earnings and then they're being too short-sighted to the long term. But I think a good management team can manage the short-term expectations, say, hey, we're spending here in the near term, the CapEx, but it's going to lead to X out into the future. And then their trusting credibility means everything to the Wall Street community. So it's up to, I think, to have a good communicator at the helm, and that's what CEOs and CFOs should be to outline their plan. So anyone who kind of goes against that and just blames the short-term earnings, they probably have some flaws in their business to begin with.
It's hard for me to thinking that moving to I guess some sort of less transparency seems like a good thing. In my mind, I would say the more the better, but to your point, it seems like a scapegoat more than anything. I mean, good companies with good management shouldn't have a problem with keeping shareholders updated and also having an appropriate long-term focus.
Dave, the example was Amazon. Jeff Bezos, they need to lose money in the near term, but Bezos did a great job of explaining, this is what we're doing. We're spending money. And yes, we're going to lose money over the next 1 to 2 years, but we're going to build something huge here. And he did a phenomenal job of Wall Street. And you know what? He lived up to what he said. So he had the credibility there. Not everyone is Jeff Bezos, though, but Amazon was that prime example. And their quarterly earnings kind of looked crummy initially, but yet the stock price would go higher because he did a good job of saying, we're building for the long term. We're in it for the long haul.
Well, one final question. Actually, Nick, was thinking one other thing to ask you about is the Fed and just the interest rate environment. I think I know the answer, but I'd love for you to articulate for people because you do such a great job of looking bottom-up analysis of all these companies and their earnings estimates and revisions, and then rolling that up to sort of a market view based on the bottom-up strength there. How does a change in expected Fed policy from, potential rate cuts to now very few rate cuts to even a rate hike was even discussed as a potential thing happening? How does that impact companies? Is that the kind of thing that you would see baked into estimate revisions in some meaningful way? Or how do you reconcile sort of a macro factor like that versus the bottom-up work of really thinking about companies and their earnings potential?
Yeah, I mean, the level of interest rates is maybe the most important variable. Like oil prices are a variable that impacts insurance. The level of interest rates is an important variable determinant of where future earnings are going to be. So if interest rates went to 100% overnight, earnings are going to take a massive hit. The interest burden, everything would go down. And the payment could be no disposable income from consumers at that point, right? So it's an important determinant. I look at it like this from the standpoint, when you have above trend growth and outlooks improving, you don't need rate cuts. And particularly with the elevated oil prices, I think that would be a huge mistake to cut rates at this point. I don't think we need to raise them either, because I don't know that the spike in oil prices is going to be sustainable. I just think the Fed standing pat right now is the right move to do it. And I know the administration is trying to pressure rate cuts, but I don't know that you want to cut rates with oil above $100 either, and the core inflation rate above the Fed's comfort zone as well. So I think we don't need rate cuts right now. The earnings are strong enough. But I know a lot of times the market, it becomes addicted to those rate cuts and wants those rate cuts. But I only say you need rate cuts when the estimates are weakening and the outlook for the economy is weakening and inflation's not a problem. Then you want to stimulate and lower rates to get it back up. But not when you have above trend growth and improving earnings. The last time we had that was 2020, 21, that they kept rates too low for too long, and we had an inflation problem. Certainly, Jerome Powell, towards the end of his tenure here, he doesn't want to make that same mistake twice.
Well said, Nick. Listen, I've always told people during periods of market uncertainty, you want to listen to voices that have a proper long-term perspective and focus on the evidence and its meaning. And I think you're one of the best at that. So thanks for coming on the show, Nick. Thanks for what you're doing, spreading the gospel of appropriate analysis of the earnings environment. And would love to keep the conversation going later. But for now, thanks for coming on the show.
Thanks for having me, Dave.
Hope you enjoyed that interview with Nick Raich. And thanks again, Nick, for coming on the show again. Nick was on the show about a year ago. It's been too long since I had him on before. And, I really am glad that he sort of compared and contrasted the conditions that he observed the last time we spoke, which is sort of, just after the April market low in 2025, and then just talked about the conditions now, not just what's happening in the Middle East and oil prices and interest rates, but just the difference in those environments. Back a year ago, we were talking about that alligator jaw configuration, which is something that, Nick, to his credit, often has highlighted with great success in his research, where you have strong price action that's not supported by strong earnings estimate revisions. And that usually is a really, really negative sign. As he wrote his recent note, this is not an alligator jaw. This is more of a rocket ship where prices going higher, but it's really supported by fairly robust earnings estimate revisions. We haven't had a lot of downgrades, haven't had analysts, pricing any sort of significant impact to recent events. Earnings have remained robust. And I'm glad he's able to talk through some of the things to look for here in the weeks to come as we think about earnings from technology, some of the big growth names, et cetera. Really appreciated his comment, if you call him, when we were talking about how strength in earnings estimates relates to sort of expected weakness or essentially weakness in consumer sentiment, consumer surveys. And I think his comments of really, look, consumer sentiment is kind of what people are saying, right? That's sort of the idea of what they're thinking. Earnings estimate is really analyzing and projecting how consumers are voting with their capital, right? With their wallets. Are they actually spending money? Are companies planning and projecting continued growth in earnings based on consumer behavior? And this is one of those times where there's a bit of a disconnect. And when you have that disconnect, it's much better to pay attention to kind of the earnings side of things, would have been his argument. Really valuable. And I would say one of the ways that I've really enjoyed navigating challenging market periods like we're observing here in 2026 with all the volatility, the sudden downswings, the sudden upswings, et cetera, is talking to people like Nick who have seen these sort of environments before. Not exactly this, but enough different cycles to recognize some of the most important information we want to pay attention to. And really at the end there, enjoyed his comments about interest rates and why those are so essential as part of the valuation process and how we're actually able to calculate the future value of projected earnings. What a great take there. And again, thanks again for Nick Raich joining us on the show. We'll try to make it not so long before we have Nick on again, because every time it comes to earnings season, I always pay a little bit more attention to Nick's work. You can find more information about him and his products that he offers at earningsscout.com. By the way, if you want to learn more about sort of the price side of the equation, earnings are valuable, as Nick offered up. And I promise I did not ask him to mention this, but I would have had I thought he would put it so eloquently. He had mentioned, look, this is why you really have to combine the earnings with the technicals, because a lot of times the charts will anticipate changes before they may be reflected in some of those quarterly earnings reports. And I appreciate him talking about and introducing and recognizing the value of combining those two in a meaningful way. So yeah, after this discussion on earnings, if you want to upgrade your own ability to analyze price action, to think about price momentum, and try to identify potential new leadership as these markets evolved in 2026, our Market Misbehavior Premium memberships may be a great opportunity for you and your portfolio. 3 great benefits to the premium membership. First off, we'll teach all about technical analysis and behavioral finance with our virtual courses. Second, we will keep you informed and updated and also engaged with the markets through our member-only reports, like our weekly flight plan and our monthly chart review. Finally, we'll keep you engaged and keep you accountable by plugging you into our member community, a like-minded group of fellow investors, navigating these markets, getting some guidance from me along the way. But the most important part of that is asking questions. You'll have the ability to ask questions anytime. I'm in there every morning looking for questions, sharing some market insights, and we'd love to have you a part of that Market Misbehavior Premium member community. You can find more information at marketmisbehavior.com/premium. Do me a favor and use the code podcast when you check out for 30% off your first 12 months on any plan. That'll do it for today. Thanks so much for joining me here on the Market Misbehavior podcast. My name is Dave Keller with Market Misbehavior, reminding you it's always a good time to own good charts. Take care, folks.